Ladies and gentlemen, it's a pleasure for me to welcome all of you here to our online seminar focused on investment ideas in emerging market. I'm Sergey Lyalin. I'm founder and CEO of Cbonds. And as you may know, Cbonds is a data provider providing data for financial markets with a main focus on bond market. And also Cbonds is a conference house, and we arrange conferences in many locations. First of all, in our home market in Russia, but also in other countries. And last year we had conferences in Hong Kong, United Arab Emirates, Italy, Spain, Brazil, Paraguay, Argentina, and some other locations as well. And with this seminar, we try to replace our Emerging Market Bond Congress that was scheduled for 2 weeks ago, 16th of April in Istanbul. So now we are doing a very, very shortened version of it in a format of online webinar. What is good about online format is that you can bring together people that otherwise would be almost impossible to bring together in one place. So we have for this seminar people registered from nearly all over the world, from Asia, from Middle East, from Russia, from continental Europe, from UK, probably with the exceptions of Americas because of time zone, but even from Americas we have some people registered. I will not speak long about current situation with COVID pandemic. Obviously, we have unprecedented shock for the global economy, something that we have never seen. This means that on the one hand, it's extremely difficult to take investment decisions because always when making some decision, we based them on a previous experience, and currently we have no experience to rely upon. On the other hand, it means that smart investment decision can be really smart and can make you a fortune. Some brief outline of today's agenda. First, we will have a presentation from Gunter Deuber, Head of Economics, Fixed Income and FX Research at Raiffeisen Bank in Vienna. Then we will have a kind of panel discussion with Gunter as a moderator and 2 other speakers, Andreas Bickel from Swiss-based Blackfort Capital and Artur Bounegra from London-based Artvera Private Wealth Management. And finally, we will have a presentation from my colleague, Alessandro Lombardo, about how Cbonds as a data platform can help you to take investment decisions. It's very important for online seminars that they are much more interactive. On the traditional seminars, typically there is not that much time for questions from the audience. Here is the opposite, and as you may see, there is a chat on your right hand. So you can put your questions in this chat and the speakers will address this question during the presentations and during the discussion. It's really very convenient and it really makes such a format much more interactive. So I wish all of you that this online seminar will be helpful for you in taking investment decisions. And of course, and the most important, I wish all of you a good health to you and to your families. So now I'm leaving the floor to Gunter Deuber, who will present his view on EM macroeconomics. Thank you.
So thanks for the kind introduction. And it's a pleasure for me to greet you here from Vienna, Austria, being in the country that at least partially starts once again with reversing the lockdown, which is positive news. So it shows that also in the Western societies, we can manage to overcome this crisis. I'm based in Vienna. I'm working for Raiffeisen Bank International. We're a mid-sized European bank, but with large exposure to emerging markets, with a balance sheet of roughly 150 billion, but more than 50% in emerging markets, mostly in Central Eastern Europe. So I will present you our EM view going forward, and then I will moderate the panel. So if we go then into the topic right now, as you see here on this slide, and as it was mentioned in the introduction, it's an unseen shock to the global economy, and compared to the global financial crisis, also the US will be hit ultra hard, and also global emerging markets will see a decline. For several countries, it will be definitely much harder, this crisis, than what we have seen in the global financial crisis. For the euro area, honestly speaking, and as I will show later on, for some emerging markets in Europe, it's not that uncharted territory than for some other places. So this you can see also on this slide, that this time around emerging Asia will be hit ultra hard, also LATAM and also Mid-East. And you see, interestingly, for EM Europe, currently the projections are more in line for a similar setback like we have seen in the global financial crisis. So definitely this is for us also an understanding that this could be a place to hide a little bit in this crisis, and that the landmines you should avoid in the EM space are possibly somewhere else. But I will touch upon this issue later on. You see, even EM Asia close to zero growth, which still had the 7.6% growth in the global financial crisis. So now we are coming more to the pockets of weakness that we are seeing in the EM space. And you see that we have borrowing needs in the advanced economies of roughly 10% of GDP. To fiscal stimulus have to be financed, all this stuff that we want to kickstart the economy later in 2021 means massive stimulus. On an interesting note, in emerging markets, we have most likely similar borrowing needs than in the advanced economies this time around, as you can see on the left-hand chart. This is definitely totally different compared to the global financial crisis, because the structural fiscal position of emerging markets worsened substantially. So as you see on the right-hand side, the emerging market borrowing needs, which were usually much lower in relative terms to their GDP, then in advanced economies surpassed the borrowing needs that we have in the advanced economies. So we see a lot of weakness in certain EMs on the fiscal side, and it will be felt from our understanding this year heavily. So EM public debt, you see it here, increased over the last decade or so on a rather steady, fast pace. Definitely in a still good environment, lower growth than previously in emerging market, but still in a good environment. And now we will see that most likely the EM public debt will increase above 60% or more. Usually a safety threshold is maybe 40 or 50% for EMs. So there was something like an emerging market debt party that most likely comes to an end now, as we see that most of the support measures in the developed market space will strongly favor assets in the developed markets, be it government bonds, be it also in the corporate bond space, investment grade or high yield. And we have maybe a little bit of a debt overhang or portfolio flow overhang in the debt space in emerging markets, less so from our understanding in the equity space. If you look from a long-term perspective, there was a massive structural uptrend in debt portfolio inflows to emerging markets, while there was not something like a very clear trend in the equity portfolio flows to emerging markets. And if you compare this then also from a structural perspective, from a more long-term perspective, there we have possibly, as it is shown on this chart here, a debt overhang of something like 400, 500, maybe 600 US billion in emerging markets. And at least for the next few months ahead, we expect that this situation normalize so that parts of this debt overhang, at least in the current situation in 20, will be corrected, and that EM outflows, especially in the debt space, will continue, at least in 20. I will talk about this later on. You could also then question the fiscal position in developed markets. And as you see here, in developed markets, the public debt increased from 70% to above 100% over the last decade as well. But we have large buyers for sovereign bonds in the developed market space, the central banks, and currently 15 to 30% of all government paper in the developed market space is with the central banks. Given the stimulus packages we could end up with 40, 50% or more of developed markets government debt in the central bank hands. This means the market risk and the marketable debt there is definitely much smaller. And this means, from our understanding, that the risks with the rising public debt in advanced economies is lower than in the emerging market space, and it will be most likely challenging for EM central banks to apply the same policies to the same extent in terms of quantitative easing. And here on this slide, you could see it also on a sectoral level, that we have a little bit of a leverage problem and debt overhang in the emerging market space. On the left-hand side, you see the advanced economies, and most sectors in advanced economies delevered since the global financial crisis, while more or less all sectors in emerging markets took out more debt, and especially non-financial corporates in the emerging market space have more or less the same debt level than non-financial corporates in the developed market space. And this time around, we see definitely advanced economies most likely to be better prepared to deal with the current crisis. So how the core region where we are in has performed vis-a-vis the global emerging market space, you can also see on this slide. And you see up to now it was a brutal hit for EM local currency, EM foreign currency, EM FX. And you see, interestingly, the region emerging Europe and at least Central and Southeastern Europe, so that's Poland, Hungary, Romania, Czech Republic, performed relatively well even in challenging times. And we expect this situation to continue at least in 2020, as we expect the bumpy ride for EM Global to continue. And you see even that also Russia, from our understanding, could continue to outperform like it did over the past challenging months. And we see EM Europe, as I mentioned, rather well prepared for this crisis, or at least with crisis management experience and less structural vulnerabilities than we have in the other emerging markets. I will touch upon this issue later on. And what we should not forget, that up to now, the risk repricing in emerging markets was still moderate, as shown here by the ambix spreads, but we think that risk pricing will stay at least at an elevated level for longer. You see also that in the end of the 90s, beginning of the 2000 years, with the EM problems in LATAM, we had elevated risk pricing there, even surpassing the Lehman level. And we see several pockets of weakness in the EM space still to unfold in 2020. So even if we have seen a certain market shock, we think for EM in total, the risk pricing will remain elevated. What is very important still is that we get a recovery going. And you see here on the left-hand side, the forecasts, for instance, by the IMF, which are more or less shared by most economists around the globe, that we get a certain rebound in 2021. From our understanding, a decent recovery is a reasonable scenario. We don't have massive economic imbalances globally, especially not in the developed markets. Large, sophisticated financial systems like we have it in developed markets, which are, I would say, much sounder than 10 years ago, are a plus now. And maybe the lockdown, what we have is a supply and demand shock, like we have seen it in some emerging market crisis now in the developed markets world. And we all know about V-shaped recoveries in emerging market crisis. So we expect a recovery, and some people in the Western world are thinking that maybe the lockdown we had was a little bit of a regulatory overkill. Let's see how this thinking will develop. But it's pretty clear that the governments in developed markets will have a self-interest to avoid a situation like we had in Q1 and Q2 now. Otherwise, all their fiscal and monetary stimulus cannot take hold. That's why it seems reasonable that we get the recovery going into 21. But definitely EMs are most likely weaker, at least in 20. As I mentioned, large-scale QE in emerging markets seems most likely not an option. There is nothing like a natural demand for EM assets from our understanding. And definitely there are more imbalances in EM than in DM. And as I mentioned, the large and sophisticated financial systems are currently something of a plus for developed markets. Here you see some classical vulnerability indicators and also the risk repricing, comparing some of the core regions where we are in, also including Russia versus the global emerging markets. And here you see what I have shown in the performance charts earlier, that definitely we have lower vulnerabilities in some of the countries in Central Europe, Southeastern Europe, or Russia compared to the EM space. So as I mentioned, could be at least a place to hide. And definitely for this year in 20, we see avoiding the landmines in the EM space, a very important topic. And we don't see the landmines in our core region of Central Europe, Eastern Europe, with the possible exception of Turkey, which has similar vulnerabilities like some LATAM countries, or South Africa and Brazil and Turkey are definitely hotspots from our understanding. So to wrap up my talks and my ideas, you see here the leverage that we built up in emerging markets. So the change of government and non-financial corporate debt over the last 10 years. And you see that there are several pockets of weaknesses. And as I mentioned, definitely some in LATAM, South Africa, Brazil, that build up substantive leverage in terms of change of the leverage and also in terms of the levels. So 2020, avoiding the landmines in the emerging market space, but for 21, we are more optimistic. The financial repression, so to speak, in the developed markets will stay. So we have ultra low rates, maybe even yield curves will be manipulated much more than now. So selective investments into EM and also debt will come back. But first, we need a certain correction of this flow overhang we have. And secondly, as I mentioned, in 20, most likely still a challenging ride for EM. So it will be key to avoid the landmines, which are mostly the countries that are highly indebted. So that's all from my side. In terms of the slides I wanted to show here, also to present some facts and figures for the discussion later on. So I think now we can move to Andreas. So Andreas Bickel, who is CIO and head of portfolio management at Blackfort, Switzerland based, as mentioned. So he is also since the late 19th on the markets. He had been with top-notch banks and asset managers before joining more wealth management boutiques, I would say. And he's currently, I think, roughly 2 years with Blackfort and has a very good market view, and based on solid economic thinking, has a PhD at the University of Zurich. He is a regular market commentator, and I would look forward to his take on the market and his investment ideas for challenging 20 and maybe more optimistic 21.
Thank you, Günther, for the introduction. I'm waiting for the presentation. Here we go. So as Gunter already said, Blackfort is a Swiss-based asset manager, or if you will, a boutique. We are concentrating on clients of the CIS space. We regularly publish market comments. Some of them you can find on the Cbonds platform. They are published in Russian and in English. We are also on LinkedIn, and we are having obviously an internet page. Given the time frame of 10 minutes, so let me try to concentrate on what is different, what are the landmines, and trying not to repeat what Gunter has said. I have a very similar opinion, so therefore this makes it easier. Key things at the moment are obviously stimulus, how we get out of this, so some scenarios, what is the impact on QE, where should you invest? And last but not least, different to what I have said, for those who have been there in Hong Kong, we believe that emerging market corporate bonds offered less value than some months ago. With no further ado, let me start with the unconventional measurements in unconventional times. Gunter said it, I was not going to speak about it, but I would call that financial repression. But we can discuss about the wording. Important are the following point. For preparation of this presentation, we had already the Fed announced we will buy fallen angels. As an example, Ford is now in the double B area, so we could say it's high yield, but for the buying program, it's treated as investment grade bonds. To my surprise, only some days later, the ECB has announced exactly the same thing. So both large central banks in the Eurozone and for the dollar area, they buy fallen angels. On top of it, the Fed has decided to buy junk bonds, as they used to be called, not directly, but through the help of ETFs. So you have a massive flow into ETFs. But that's not enough. On top of it, the Fed, together with the finance department and the help of BlackRock, decided that they will give credits to smaller and mid-sized enterprises. This is unprecedented. On top of it, we see a kind of helicopter money. And for those who have come across that expression in the past, it's not a purist form. The purist way would be that central banks provide money to individual. In the actual cases mentioned here, for instance, the US or Japan or Hong Kong, the money is paid out of the state budget directly from the government. In Singapore and Macau, it's slightly different. There you get a kind of voucher to go shopping. But the important point is this thinking experiment is at the moment going to be in some countries a real implemented measurement. In the US, they're even thinking of adding a second tranche in 1 month's time. In individual countries, that excludes most of the emerging market countries, the fiscal stimulus ranges between 10 and almost 20%. If we aggregate that globally, this was done last week, stand Friday morning, it has reached almost 9% of global GDP. But unfortunately, or maybe as an investor, fortunately, the European Commission has proposed a 1.5 trillion reconstruction program to help Southern European states. This would be 10% of the Eurozone aggregated budget. That's really, really huge. Last but not least, Japan for a while, and now Australia, they have implemented yield control. So they control the yield curve. To my surprise, the Fed is discussing this as they face the problem of negative yielding government bonds. And in order to control that, one measurement could be yield curve control. What I didn't know is in the Second World War, America had this measurement already. And here we are back to the theme of financial repression. If you fix at that time the yield curve at 2.5% for the 10-year and you have inflation of 5%, you can do the math what that means. Basically, you take money away from the private sector. Unprecedented times means also we have seen We have seen a lot of rate cuts. This weekend, 69 cuts in the last 3 months, most of it obviously in March and now in April. We are almost at the level of 2008. There's one key difference to that time. This time, the financial sector is in good shape, and at least for the time being, this is an imposed crisis from the governments through a lockdown in order to prevent the spread of the virus and to go out of these lockdowns. The next key point will be to prevent a second, third, fourth, etc. wave. To put that in another perspective, I took that from AB, former known as Allianz Bernstein. This on the left-hand side are the government bond purchase programs. As you can see, year to date, only government bonds has reached levels never seen before. Different to 2008, it's a kind of coordinated or at least simultaneously action of the 4 largest central banks in the world. Forward looking, these 4 banks are supposed to buy much more assets and not just government bonds. The politicians are in a whatever it takes mode, like the central banks. As said before, global stimulus is reaching 9% of total global GDP, and if the European Union will implement this additional 1.5 trillion, we will soon surpass the 10%. Everybody, including myself, has something like this in mind. Basically, we have in Q2 a sharp decline in GDP. The Anglo-Saxon, in particular the US, for instance, Mrs. Yellen, former Fed chair, said, analyzed GDP will be more than minus 30%, so 30. What she didn't say, or what is a bit different for European, they analyze quarter-over-quarter figures. For the whole year, we would argue that the US might go down 2 to 4%. Nobody really knows. But the key is not that. The key is what comes after. The main scenario is that we will see a kind of recovery, like Gunter said before. However, this depends strongly on how we are going out of this crisis and how we are able to prevent a large second outbreak. You can see China and Korea, they are far ahead of the curve in terms of the status of the cycle of this first wave, and in particular in terms of controlling. Germany, Austria, Switzerland, all a bit smaller countries, but we have all started somehow to reduce the lockdowns. Politicians make a lot of pressure that, like in the US, we go fast out, but the key problem is if you go fast out, you might have a second outbreak, and then you have a stop and go. And the stop and go would mean that you get to a point or a second scenario, which I called a long-lasting recession, followed by a kind of financial crisis. Because if we would have a long-lasting recession down the road, all these credits are given to the bank, to the enterprises will somehow spill over to the banks, although the government is supporting it. Nevertheless, the most likely outcome is a kind of combination of scenario 1 and 3. There will be V-shape, U-shape, nobody knows, but there will be a recovery in H2 and in particular in 2021. With the risk that all these measurements will overheat the economy and will push up somehow inflation in a wider range. So melt up in asset prices is also part of it. And as Gunter also said, all the governments are really careful that these measurements put in place so far are useful, helpful. Therefore, the way out of the lockdown must be in a smooth and contained way, and one has to be careful not to give in to the politicians. The key point is where to invest. I believe at the moment, if you just look at spreads, we have seen the slide in a different way, but with similar data just before. The four main areas we look at, so US high yields, emerging market hard currency high yields, globally aggregated, and LATAM, they are at similar levels. What that means is if you risk adjust returns or your expectation, we strongly believe that different to 1 year ago, US high yield offer the best value. Maybe followed by US equities, although they are expensive, but due to these measurements we have seen. Nevertheless, similar to what we have said in Hong Kong at the conference, we like Asian corporates, although you have to be very selective. China is at the forefront. I would agree with what I have heard before from Gunter. So we are invested in Russian hard currency bonds. We are selectively invested in emerging Europe bonds. We are extremely cautious with LATAM-oriented bonds. However, the key, if you invest in corporate, is that you really do a case-by-case study. And this is basics, but I just have written it down. If you invest, check the balance sheet, check the liquidity of trading, try to have a view on the forward-looking cash flow projection, and maybe these companies might be rescued from the governments. The case of China is here summarized. Given the time frame, let me rush through it. So basically, you see that the power consumption is up year over year. If we compare April with April, bank lending has reached a tremendous level, but the government initiated that, so that's kind of normal. Almost 98% of large companies are up and running like before. The industrial production in March compared to 1 year ago is, in brackets, only down 1.1%. In February, we were almost 26 down. If we look at smaller companies, the capacity utilization is at roughly 83%, while the larger ones are at 98 roughly. Therefore, we can say the measurements they have taken to go out of the lockdown really start to spill over. Last but not least, you see that the property sector at least has not seen a sharp decline in prices. There has obviously been a decline in contracts, in signed contracts, but forward-looking, we believe that might be an area which is a kind of safe place. Different from the Western world, why China, and why does it work in South Korea? Well, basically, they control every step you do, be it by software, be it by testing. If you go somewhere working, before you can check in, you are checked your fever, etc., etc. If, however, you had contact with a person who is at risk, you get immediately isolated and you have to be at home. All this to prevent an outbreak of the second wave, which they have really done. Maybe for the discussion, we are multi-asset investors. So although our specialty is emerging market debts at the moment, we would argue that gold and equities must be part of your portfolio. Then US high yield, as said before, we prefer the BB space. And selectively, we like emerging market corporates, in particular China and to a certain degree Eastern Europe, as we call it here. Last but not least, for all those of you who are portfolio managers, go through your portfolios and check all the fallen angels and make a case if you would buy it today or not. If not, then sell it. To sum it up, all assets are, from our perspective, expensive. This obviously depends on the outlook of growth. We believe that government bond yields, in particular in the US, might go lower from levels we are at the moment. All this stimulus is so huge that there is a risk of financial melt-up. But last and definitely not least, this whole view depends on the effectivity of all the measurements. But equities guys and US high yield guys are surprised why markets go so much up. And the answer is straight in front of you, and it's very simple. It's don't fight the Fed. Goldman Sachs said, actually, markets should be 25% lower, or estimated earnings for next year should be 25% higher. Both is not the case. Both is at the moment not happening, and higher earnings, I would say, is very irrealistically. Therefore, the only answer why we are here where we are these unconventional measurements. With that, I hand it over.
Thanks, Andreas. And we can definitely discuss later. And we have definitely already a lot of interesting questions in the chat. But in this panel, we have also a second presenter. So hopefully I pronounce the name right. It's Artur Bounegra. He's founding partner at Artvera, the private wealth management, also boutique based in London. I think he's roughly since 2012 there, has also more than 20 years of experience in the financial industry, also with large international banks. I think even including Raiffeisen in Russia. I saw it in his CV somewhere. So a lot of experience also in emerging markets, obviously also having a PhD and MBA. So definitely an interesting adding to the panel here. So Artur, go ahead with you.
It's extremely valuable. If you don't mind, I would divide my short presentation into two parts. The first one will be dedicated to our outlook of global economy, and the second one I would like just to briefly touch upon our view, how our company is currently managing our clients' assets. So there is no doubt that we are currently experiencing unprecedented shock of both sides of the economy. The first one from supply side and the second one the demand side. And in some sense, this is artificial crisis because it was created by governments and a lot of other regulatory bodies in their attempts to save economies. And in some sense that it means that the value of human lives currently has become extremely high, and a vast majority of countries are ready to sacrifice their economies in an attempt to save the lives of people. So more importantly, I would say that one of the conclusions which we can make from this crisis is that governments and regulatory bodies have responded heavily and very actively by introducing a lot of measures in fiscal policy and monetary policy. And these measures have become already quite effective. And what I would like to mention specifically, that one of the possible outcomes of this crisis, just speaking about the nearest future, will be definitely from our point of view, that the governments of various countries will become the ultimate owner of many businesses which otherwise would have become bankrupt. And obviously, in order to save the economy, every government will have to issue a lot of new debts, and there is a huge question how these debt will be repaid in the future. So all these questions are still not clear enough, and rather interesting how it will be developed in the future. So a lot of opinions as regards to what will be the recovery, whether it will be a V-shape or U-shape. And from our point of view, there is a higher likelihood that the recovery will be U-shape, because before this crisis, global economy didn't have many imbalances, and more or less was balanced enough, especially U.S. economy. And there is a hope that after lifting the current lockdown measures, we'll be seeing some gradual recovery, especially in that sectors which are less vulnerable at this stage. So, if you don't mind, I'll briefly touch different parts of the world. So, because the information is progressing permanently, we are currently slightly worsening our previous projections regarding the US economy. For example, we have already decreased our forecasts to almost 8% versus our previous projection of 2.1% of contraction. And speaking about Eurozone, of course, which was affected most of all, we are currently seeing that there is a very high likelihood that there will be a contraction of around 9.5% this year. So everything will largely depend on how the pandemic will progress. And of course, nobody knows exactly from a medical point of view. But again, if we are assuming that the lockdowns will be slightly lifted in the next month, so there is a hope that we'll be seeing some first signs of recovery again, in particular sectors of the economy. Speaking about the UK, where we are based, we unfortunately in this case we have an excellent opportunity to say that UK also reacted very rapidly in terms of introducing a lot of supportive measures to their local businesses and to households as well. And as you probably know, UK currently is the most effective country, not only in Europe but in the world in terms of total number of cases and in terms of number of deaths, unfortunately. And of course, a huge issue is still unclear how all these events will finally affect the started negotiations between EU and UK as regards to the future of the UK without the EU. And there is a high risk that the previous deadline, which was set on 31st of December this year, will be delayed. Again, speaking about the sterling, because of all these uncertainties with UK economy, sterling remains very risky asset, very unpredictable, and very again vulnerable in the nearest future. And we are forecasting very high volatility in this currency within the next couple of months. Speaking about, again, maybe I will briefly touch upon Japan. So, as you probably know, Japan has already introduced and declared state of emergency for the entire nation. So, and all this led to the decrease of our previous forecast. China, despite the fact that China was the origin of this crisis, currently, as you also probably know, that China has already started to show some signs of recovery. Of course, it cannot be considered as a stable recovery, but there is a hope that the China, despite the initial forecasts, will be less affected than the well-developed markets. All these undoubtedly could not could not be affected on our own business, our company's business, and I'll just try to briefly cover our today's strategy, which we pursue as regards to managing our clients' assets. So, as many other companies working in this field, we were anticipating some sort of recession. Of course, to be honest with you, we didn't expect simultaneously two so-called black swans, and nobody could expect such a huge global pandemic. But in an attempt to be very well prepared, we were trying to keep as much cash as possible. So we reached almost 10%, and we have already used this cash when trying to find very attractive, from our point of view, very high quality assets, mostly in bonds. Speaking about our strategy, so again, before crisis, we tried to keep to the loan-only strategy, and not taking any leverage, but we are slightly adapting our investment approach and already gradually introducing some leverages into our clients' portfolios. Again, we have to bear in mind that in order to be very efficient and very successful in investments, you have to be extremely cautious, especially in such challenging times. And that's why our strategy implies a very selective approach in terms of choosing a particular issuer. It's worth mentioning that we don't stick exactly to formal rankings, whether this is a BB or BBB. We try to view and to analyze the particular issue more comprehensively, trying to understand their fundamentals. And of course, we're trying to understand who are they, who are their competitors, who are their shareholders, whether or not this type of business will be less or more affected during the pandemic, and so on and so forth. So I'm not going too deep too much into our strategy, because of course it's more technical issue. But overall, I would say that in the coming months, everything will depend on your investments profile and your time horizon. If you're ready to, let's say, invest in 2, 3, 4, 5 years, obviously this is an excellent moment for finding very attractive investment opportunities. But again, because of very high volatility during the next couple of months, you should be extremely cautious when selecting particular investments, and I think the diversification is still the key. It's extremely difficult to anticipate exactly how the pandemic will be spread across the world, and whether there will be a second wave or one wave. So we are currently sticking to the point of view that there will be just one wave, but unfortunately it can be wrong. But so that's why you have to be extremely cautious and try to diversify in terms of geography, in terms of industries. So probably one of the most attractive, I would say, investments in the next couple of months would be high yield bonds in corporate sector, mostly in developed markets, and with a duration between maybe 1 year and 3 years, in order to be well secured in terms of possible future volatility. So probably I would be ready to answer questions if you would have any.
So we have a lot of questions to answer.
Yeah.
So I would pick now some questions. Maybe I will also give some indication how I would see it, but definitely I would like then to have also the views of Andreas and Artur. So there was one question about the ability and capabilities of EM central banks to maybe follow the same policies like we have in the developed world, and to what extent we might see EM debt being part of this monetary policy stimulus we see in the Western world. So from our understanding, some of the most mature emerging markets with a high degree of institutional quality or very strong balance sheets of the sovereign. So, for example, some emerging markets being part of the European Union or also Russia definitely could apply some QE or other sovereigns with strong balance sheets, but for the weaker ones, it will be no option. And we don't see EM debt to be part of the global stimulus exercise per se by the major central banks. The swap lines are maybe a little bit of a cushion by major central banks. In the region where we are in, we are currently in discussion with IFIs. This is EBRD, for instance, that they offer us as banks active in the region certain guarantees to sovereign exposures, because we see also hefty pressure for us in financing sovereigns in the region. But nevertheless, I think the overall claim we made, Andreas had it more or less the same way, that the stimulus in DM will largely benefit DM. I think this holds true, and that's the sad picture for EM, but would be happy to have your view, Andreas and Artur.
Well, China, or the People's Bank of China, is doing a kind of monetary stimulus, and there is a hidden way of stimulus from the state. I would agree that Russia would have the possibility, and with the rest, not really aware of that other central banks, apart, for instance, the Turkey, but Turkey is kind of manipulated by the president. They have recently cut interest rate with negative impact. But on the other hand, is going to help to a certain degree is that the United States tries everything that the DXY, so a kind of weighted average dollar index, if dollar is weakening, that indirectly will or would help emerging markets. But I tend to agree what Gunter has said about other emerging market countries.
I also agree with my colleagues. The only which I would like to add, probably that we have already hit the zero interest rates, and in my point of view, there is not so much to do for central banks at this stage. And the only probably issue of the next couple of months will be how effective the governments will be working in terms of savings, different types of businesses by direct investments in these businesses. And this will be the key issue, because again, from a monetary side, everything which had to be done has already been done. And the big issue, whether or not the governments will have to save everyone, or it should select particular businesses, which is extremely important for the economy. And as I said before, all these a huge dilemma whether or not the governments should bear all the costs on their budgets, and how these budgets will be financed, and who will pay all these debts in the nearest future.
So thanks for your answers. And we had several questions. I think, Andreas, you also tried to answer some already on the fly in between, but I think it was a imminent question here also about what could be the midterm, longer term effects of all the measures we currently see, or of the bazookas we have in the developed market space on inflation and asset prices. Yeah, so definitely would be happy to get your views here as well. Maybe we start then with Artur first and Andreas second, and then maybe I will round up with my view so that we have a different ordering now.
Yeah, could you please repeat your question once again, please?
So what's your take on asset prices and inflation from the extraordinary stimulus we have in the developed market space? Yeah, and definitely some midterm effects, so 1 to 3 years. Yeah.
I don't think that the recent packages of huge liquidity injections will badly affect the inflation both in developed and in developing markets, probably because this liquidity will be absorbed by the businesses, and in some sense it is there is no much threat that this liquidity will be in consumption in the nearest future, because the demand side of the economy was already contracted, and that's why the global demand was already postponed. So I don't anticipate high inflations, at least in the nearest future, and I think that again, depending on particular country, we can be witnessing different data, and but in well-developed countries such as UK, US, I think the inflation rates will be more or less stable within the next couple of years, I think.
Well, this is how to say a very difficult question if you try really to answer it in a, let's say, segregated way. But if we start with CPI, take the US as an example. I'm not in front of the figures, but basically 90% of everything they produce, they consume internally. Take the example of little Switzerland. Most of what we consume, we must import. Also in Germany, they import, for instance, fruit from Spain and Portugal and Italy. But this chain is disrupted. So in certain market segments, CPI is affected by sharply rising prices, while in other areas, for instance, cars, I haven't seen large discounts, but they restarted producing in Germany. There's overhang of car. There is a huge storage overhang. In theory, there you should see disinflation. In terms of PPI, so input factors, it really depends what you need, from where you get it. And last but not least, I know it is not inflation, but I would add it to the list. Kind of asset prices. Look at gold. I mean, gold rises for various reasons, but it is definitely in a strong uptrend. As we speak, equity markets, different to bond markets, have risen for the third consecutive day in a row. Is that inflation? Question mark. So in the end, I saw that in the answers, it really depends where you are and what you import and what you produce and what you consume. Probably the general answer that short term, on average, you have rather a disinflationary scenario can be true, but midterm, due to interrupted chains of deliveries and productions, etc., there will be huge dislocations in various parts of the market.
Thanks for sharing your thoughts. I think also we should keep in mind that even if we get the recovery ongoing in late 20, second half going into 21, for most of the developed markets, we will stay 5-6 percentage points below the projected pre-crisis GDP path. Yeah. So at least I think from the next 1 to maybe 3 years perspective, strong inflationary pressure is not so likely, as also the labor market most likely will take a hit at the later stage. We have all these short-term working schemes in Europe that will possibly help, but still unemployment rates will rise. So I think we are, at least from a developed market perspective, still a little bit away from an inflationary scenario. I think from the asset prices, we have to take into account that it's the second time in maybe 10, 12 years that the official sector is bailing out the private sector. And I think the discussion about that the private sector has to contribute, shoring up the situation at the later stage, maybe via special taxes on dividends, whatever, yeah, will be also part of the game. So we have to be a little bit cautious that asset prices will go up easily, because I think governments want to recoup some losses and definitely don't want to see that once again, yeah, the wealthy will profit from the crisis response. I think this is something we have to keep in mind, and could limit a little bit the asset price gains compared to what we have seen in the last rounds of strong QE in the developed markets. So there are several questions regarding the frontier markets on the sovereign side, some weaker countries like Nigeria, also maybe we touched upon this, also LATAM countries. And there are several questions about also corporate bond exposures, also in the Gulf countries and the sovereigns in the Gulf countries. So definitely, I think, Andreas, you tried to answer some of these questions on the fly. Maybe Artur, you also have some views, so definitely time to share them. I would just raise also the topic in the beginning that for at least several, I would say, sovereigns, yeah, but maybe also for corporates, yeah, the crisis now is a good excuse, yeah, for some people that over leveraged previously now to restructure, yeah. And we are still coming from a relatively low base, yeah, also in terms of sovereign defaults, restructurings, yeah, and also in the corporate sector. I think we have to be prepared for much more, and definitely for some people it would be, I think, even tempting now to use this crisis to push forward such options. And yeah, but would be interesting to have your views. I don't have too strong views on the Gulf countries, or be it the sovereigns or the corporates. Yeah, so definitely happy for your contributions. So Andreas, can you share maybe your thoughts?
Well, first a disclaimer, I'm not an expert on frontier markets. So, for instance, this morning I have seen that there was sovereign bond issue in Pakistan and Indonesia, if I'm right. Basically, huge bid-ask spread and an overhang of capital, and it was hard to place them. Gunter said at the beginning, we are to a certain degree invested in LATAM, but there in the corporate space, and then it boils down to you have to do your homework. Or I can give you an example of Mexico. There's a financial intermediary there. Basically, after Mexico was cut, the hard currency bond dropped by 30%. The outlook of the company, I'm unfortunately not really able to give you here recommendations due to compliance, but basically the outlook of the company and the sector has not really worsened yet, because obviously in Mexico, like other countries, they have challenges forward. Or if you look at Pemex, and in Pemex with the actual oil price, like other oil companies might be at the edge to get bankrupt. However, there is the backing up of the state, similar to Russia, but Russia is definitely more getting a developed country than an emerging market, and definitely not a frontier market. You see that also in yields. I saw in the panel a question regarding India. We had investments in India. We felt very uncomfortable at the beginning of the year with reforms of Mr. Modi and with the outlook. And we reduced it, unfortunately not 100%, only roughly 80%, but at least we were not hit so hard. And China is a tricky case, because what is China? Is it an emerging market? Is it already developed? In some spaces, it has obviously also kind of characteristic of frontier markets, or at least of markets which are not free. And that's another aspect. A lot of governments are profiting from the situation, A, to restructure, Argentina is a good example. But B, also to put in place measurements which put you farther away from a free democracy place. So in the end, it is really a case by case.
Yeah. As far as this question is concerned, as my colleague also mentioned, unfortunately, we being hugely regulated by UK FCA, so we are not allowed just to give exact examples of our particular investments. But again, just covering the regions, I can say that first of all, we tend to choose corporate bonds versus government bonds, especially under current unprecedented times. Speaking about the regions, we are widely spread across the world. We prefer, if speaking about Asia, we prefer Indonesia, like Thailand as a destination of our investments. Again, everything depends on particular companies in this region. We try to avoid China just as a general destination, but again, we still invest. Some of our clients still invest in China and not in real estate, not in infrastructural projects, and so on and so forth, mostly consumer sector. Speaking about other emerging markets like Brazil, but as my colleagues already mentioned, you have to be extremely cautious about such names as Pemex, for example, as Mexican conglomerate, and there are a lot of issues regarding producers in Brazil, and so of course a lot of political tension is in Brazil, and it's not quite clear whether or not they will be able to cope with these risks in the nearest future. But what else I would like to say regarding the developed markets? We heavily invest in the US economy. Also, we like some sectors in IT and other technology companies. Again, everything depends, as I said before, on time horizon and the disposable assets to invest. Because if you have sufficient amount of assets, you can be very widely diversified. And of course, we strongly don't recommend to try to pick a particular issue and to win the game, because under current circumstances, it's almost impossible to anticipate how a certain company will be performing, and whether or not this company will be in the list of those who will be supported by the government in case it's needed. And I would say for the average investor, I would strongly recommend to stick to a very well-balanced strategy, not trying to get the maximum possible returns, because it's extremely risky, just in general, in our normal times, and especially in such challenging times. What else? Speaking about Russia and CIS countries, we don't have investments in this region currently, but again, we try to avoid all oil producers and any contractors which are to any extent connected with oil. But this is not due to current situation with oil prices. This is just a part of our strategy. Try not to rely on this sector and to be more, I would say, more diversified in terms of different regions and different sectors of economy.
There were also several questions with regards to the differentiation between financial bonds and corporate bonds, EM financials and corporate bonds. I think I touched upon this longer term leverage story in emerging markets. And honestly speaking, from this perspective, I think corporate sector seems to be more exposed because EM banks did not leverage up from at least what you see on the market, yeah, to that extent like corporates, yeah. And also EM banks did not get massive additional financing lines from DM banks in the recent years, yeah, compared to the situation we had prior to the global financial crisis, yeah. So looking from a big picture leverage point of view and also from a big picture banking point of view, also looking at what Western banks are doing in the EM space, I would be more concerned about corporates from EMs that leveraged on markets on the debt inflow party we have seen over the last few years. Yeah, this would be my take on the situation, but would be interested in yours, Artur and Andreas. So maybe Artur, you start first with your views, and then Andreas.
You mentioned about the banks and large banks in Europe. So I could tell you that not so long ago we had some requests from a couple of clients to specifically consider these type of investments in similar bonds, and they were lucky enough to invest in these bonds right at the bottom of the prices which we saw approximately 1 month ago. And again, our forecast regarding this particular type of issues is more or less favorable. We think that and hope that despite that, unlike the crisis which happened in 2008 and 2009, this is not the crisis coming from banks and from bad debts, and that's why the investments in financial sector is less risky than it was during the previous crisis. That's why if you, for example, are seriously considering investments in financials, you should try to find some attractive bonds which are still available. Especially we can speak about so-called subordinated bonds and so on and so forth, which still can give you rather attractive returns with the maturity up to 2, maybe 3 years. And we hope that even in the worst case scenario, these companies, these banks, will be anyhow supported, or in the worst case, just nationalized by governments or for particular countries. So we seriously think that financial sector is less vulnerable under current circumstances in comparison with others, for example.
Before handing over to Andreas, maybe also some words also from my side. I think the deep discounts we see on some instruments is maybe not because of the fear that those institutions will be bankrupt, yeah, but I think the cost of capital have changed and may change over the next few years compared to what we have been used to over the last few years. Yeah? And I think this is also reflected in the bond prices of such instruments than per se a rising risk of default. Yeah? So, and we have this in larger economies in Western Europe, 100% state guaranteed programs currently. I think this is also a big cushion for the bank balance sheet, from my understanding, yeah, compared to the situation where we had been a few years ago. But Andreas, would be happy to get your views here.
I mean, the last argument you made is basically why we prefer at the moment US assets. I mean, even if you are a shale gas producer and you have a certain size, the likelihood that somehow you get saved, although you are going to default, has risen dramatically. Therefore, I have said that before, but risk return, given the spreads, we prefer US high yields over almost any emerging market hard currency bonds. I would agree as well with the statement so far. This is not a financial crisis. Banks and financial institutions are in a much better shape. Corporates have leveraged up, are exposed beforehand to the economic cycle. We have seen that there will be a strong hit now in Q2. There was a certain hit in Q1, and it's completely open how strongly this will recover in H2 and next year. The chart I have shown before, we can argue about sizes, etc., but that one was from PIMCO, and PIMCO basically claims the only country which might, and I repeat, might come above 100%, so above the pre-crisis level of GDP, might be China. All the others shown in that graph will not reach in the next 18 to 24 month levels we have seen before. And that makes it obviously extremely risky for corporate firsthand. And second, most of them, at least outside of the 4 big countries where we have these saving programs, they lend money from the capital market, but also from banks. I wouldn't rule out that down the road some banks will start to have problems. If they are lucky enough that the headquarters is somewhere where you have this bailing program, all fine. But there are a lot of places in the world which you don't have this. And then we are back to what we have said several times before. You have to do really case by case your homework. You have to be broadly diversified, and it's probably wise not to lengthen your duration.
So you gave also a very clear answering once again to the situation or trade of EM versus US high yield, and I think this was a view shared also by us in the first slots with our presentations. And with regards to the corporate sector, I just want to add we have the first evidence here in Western Europe also on the sectoral hit of the lockdown. So in the economies in Central Europe, including Austria, we have lost something like 30% on aggregate in gross value added in the lockdown period. And for some sectors, the losses are at 60 or 70% in the service sector, in manufacturing, and also in some trade sectors. And even if we get a recovery going, and in a recovery scenario like it is assumed in most of the assumptions, and we discussed them in the beginning, this still means that the economic output will be something like 10% below the pre-crisis level, but that's on aggregate. There will be sectors that will remain 20, 30, 40% below their pre-crisis output levels even by the end of 2020. And I think these are then the sectors that would definitely run into cash flow problems and all this stuff. And that's why I think we have to be definitely cautious here. And the sectoral impact is definitely something we have to closely follow this year. And for some sectors, they could bring back some of the cash flow they lost, but for some sectors, this will be definitely lost. And I think this is also creating a lot of uncertainty in the corporate investment space, this challenging sectoral outlook we have. I'm not sure if you have any strong sectoral views, but maybe we get also some interesting rotations. We see currently that at least in some countries where we are operating in, then some companies that are in the packaging sector that were previously hit hard by all these renewables and greening initiatives are now booming because this is changing and people want to pack once again things more in plastic that they thought before. So there could be some interesting opportunities as well out of this crisis. So do you have any strong sectoral views as well? And maybe in the end, we could also share a little bit our view on the oil price, because this is something not just of importance for emerging markets, for developed markets. And I think you should have one as well as part of your investment strategy.
In terms of sector, bluntly speaking, everything which might profit from this COVID-19 illness. So I'm talking of biotech, of healthcare, of nowadays they are not called techs anymore, but of these online services, of transportation. You mentioned the packaging industry. I mean, I have seen yesterday, for instance, a documentary. The canteen is closed. Nevertheless, you go there and you pick up your food in plastic wrapped, and you eat it at your desk with 2 meters distance. So there are areas where you probably will profit. I mean, a very stupid example is companies which produce prefabricated food. So they found out that although we are all at home and people don't cook like in the past, but they buy prefabricated food. There are several large companies. One is based in Switzerland, but there are others and they profit from it. But this is coming more from the equity side. Nevertheless, they also do offer in some cases bonds, and at least it's worth having a look at such areas. The oil I share for later.
Well, speaking about oil prices, as usual, to forecast the behavior of these prices is I would say, this is a absolutely stupid exercise. And of course, so many factors can affect these prices to move in different directions. And as we've seen in the last couple of weeks, when we are witnessing a huge volatility and even negative prices. So, of course, I would strongly, I would strongly not recommend to, for the average investor to try to beat and to bet to have any bets on oil prices in the current next couple of months. At least till the stage when some stable signs of recovery will be seen. Of course, in the medium term, there is no doubt that oil prices will not stay at the level where they are now, but it's extremely difficult to anticipate whether or not, again, this will be a so-called second wave. And if in the worst case scenario there will be a second wave, of course, this will undoubtedly affect oil prices again. So in the midterm scenario, speaking about 3 years, let's say 3 to 4 years, obviously oil prices, current oil level of oil prices is not favorable for any oil producers, regardless whether or not they produce. They are connected with in terms of whether or not they are effective producers or not, what is their structure, costs, and so on. But I would say that the volatility will remain very high, and I would strongly not recommend to invest in futures in oil, trying to again to obtain some maximum gain.
May I just add, I agree with that, but just one word of cautions. There are ETNs, so exchange traded notes, not ETFs. They invest in oil futures, and there are a lot of retail investors invest in them, not knowing what they are buying, because basically you buy the next 2 futures contract. They are in contango, i.e. the prices is higher in future than the actual one. And you get dislocations like we have seen in the WTI futures contract when it expired in May. And even if the oil price might move up slightly, which is likely, you will still lose money if you buy such products. So I definitely agree with the statement. Don't really speculate on it. The oil price is at this level not sustainable, but we have at the same time a demand and supply shock. And on top of it, we had at least for a short time this war to produce more oil. And even if this cut is really implemented in May, we have still too much oil produced. So therefore, I know there's no answer, but the volatility will stay high, and it will be extremely difficult to make money. And we are extremely cautious and definitely don't speculate in the oil price.
I think from a pure economic point of view, as I touched upon this, in the advanced economies, the lockdown currently costs 30 to 40% of economic output and most likely also oil demand. And we just have a cut of 10% of oil on the table. Yeah. So there must be more, others have to join, or the economies have to recover substantial. And in all the baseline scenarios, we are year-end 20 still 10% below the pre-crisis GDP level. So for 20, it will be hard to see a massive oil market rebalancing, maybe more going into 21. Yeah. So this is at least a few, unless we don't get from our side too much additional joining to the current agreement. And then there is also one question on the EU sovereign bonds before we then maybe have to close this session. And I think looking at the EU sovereign bonds, it was pretty clear that this time around the ECB was pretty front-loaded compared to previous crises. And it's pretty clear that in such a situation where it is not an economic crisis, but a humanitarian crisis, even the Dutch and the Germans are not enforcing the things too hard. That means from our side, the PEP could be continued if needed. The ECB will act as a buyer of a last resort, at least in this crisis, for longer. And for Europe, we don't expect something like a tapering discussion at all, or that the ECB will get rid of the bonds at some point, because the ECB portfolio is definitely much more risky than, for example, a Fed portfolio, if we look at treasuries. And that's why we see a natural strong demand for EU sovereign paper from the ECB over the next years to come, for the next 5-7 years, whatever. Alone, the reinvestments already are something like 100 billion at some point in time, giving the portfolio. So we think at least, for the time being, spreads will be well contained, and ECB will even lower the benchmark rate. So we don't see a euro area sovereign crisis unfolding once again in Europe, at least over the next 1 to 2, maybe even 3 years. This is our base scenario, but would be happy to get the scenario analysis from the people outside of the euro area before we then close this session and hand over to the Cbonds guys.
So, I mean, we are having Swiss franc. I strongly assume my colleague has pounds, but he should speak for himself. I agree with your view. I'm astonished to a certain degree how fast and how proactive the ECB was this time reacting. But honestly, given the new president, I would argue it had to be expected. But the good point is that the constraints or the political pressure not to do that from Germany and the Netherlands very, very small. And there is a huge argument, Corona bonds or no Corona bonds, Euro bonds, or whatever you want to call them. The northern countries, the one which in the end will pay part of it, they don't want to have it in that way, but they agreed that they use the European saving mechanism without implementing the constraints, because normally, like Portugal had to do or like Greece had to do, you have to have budget discipline, you have to save, etc., etc. This time, you will get money, you will get bailout, but restructuring needs, at least for the foreseeable future, are not forced on you. Nevertheless, I mean, debt to GDP of Italy is expected to rise somewhere above 150, maybe even 170%, and we probably all know what that means down the road. How they are going to solve that has to be seen. Inflation might be the solution, but we have discussed inflation before. I mean, a sharp rise in inflation, I really don't foresee, especially not for the Eurozone, given the lackluster growth. But you can turn it around as an investor to buy sovereign bonds from a southern country. Whatever the rating is written there is probably too high, but the risk you have is extremely low, because in the end you have somebody who buys it for you, and that's the ECB.
So what's the view from UK?
In general, I would agree with your approach, but just one thing to add. First of all, I have to mention that obviously ECB, as any other regulators, approach this crisis being much more prepared to any challenges, and of course, the most difficult question and the most, I would say, difficult challenge in the coming years for not only for ECB as itself, but for Eurozone as in general, will be not economic side of this issue, but more political side, because current tough negotiations between EU and UK as regards to the future of both UK and EU without the UK. So this is one of the example how the EU should, I would say, learn from the experience of dealing with the UK case in order not to repeat this in the nearest future. So all these imbalances, which still unfortunately exist within the EU as a union, which mostly cover not only economic field but a political side as well, have to be extremely considered and solved in the nearest future in order to be more productive as a union, to be more effective on the global scene. And I think this is the most challenging time for EU as a I would say the family of nations, how they will be able to couple with these challenges. So it will be interesting to see.
So thanks, Artur and Andreas, for your engagement, our active discussion here in various locations. I think it worked pretty well from a technical side. We had a lot of interesting questions, and therefore also many thanks to all the participants who challenged us and were really looking also for concrete answers. So I think from a timing perspective, I have to close this session now, and want to hand over to Alessandro Lombardo. I think he's from the Cbonds International Department, because I think on the schedule we now have also a presentation on their capabilities. So thanks to all participants and the discussants here, and I think we touched upon a lot of interesting questions.
Thanks from my side, and goodbye.
Thank you so much. Thank you. Take care.
Hello, everyone. I think we can start. First of all, nice to meet you. My name is Alessandro Lombardo. I work in the international department of the company Cbonds. And today we are going to have an overview of the platform that we provide for bond investors. And not only, because now I will show you that we have some new tools, not only regarding bonds. We are very happy that we could organize this online seminar. Let's say that our main aim every year is the one of providing with investment ideas to our clients, and not only to all participants. And we plan to continue to do it. We would like also to make to organize some conferences where we can be able also to provide some concrete examples of investment ideas. And to show them also in our platform. So we will try also to manage to do both at the same time. So let's start the presentation of the platform. I will now share my screen. Give me just 1 second so that I can start to show all the main tools of our new platform. So here we are. Yeah. Okay, we can start the presentation of the new premium platform of Cbonds. Let's say that the most important thing to say to begin this presentation is that the interface of the website is now completely new. So as you can see, it is quite user-friendly. It's very easy to use, and it's very interesting also in the first page. So as always, we have several ways of receiving our data. Today, I will focus only on the web access, but we provide different ways of receiving data. One of them, as said, is the mobile app. The second one is the Excel add-in tool, and then we have also the API data feed for to receive in a structured way our data. So today we are going to focus on the platform, so on the web access, and we are going to start to show what's changed since, let's say, the introduction of this new platform, and also what now we were able to implement in the new one. So let's start using the quick search for bonds, stocks, and indices. So I will show in what way we can see all the information at the same time. So for example, if we type the name of one issuer, it could be Apple, for example, we can immediately have an overview of all the bonds and stocks that are now outstanding for this issuer. So of course we can select any bond from this list, and then we can see all the information in the issue page about this bond. We are going then to speak in a detailed way about the issue page. I just wanted to show you that now it is possible through our new quick search for bonds, stocks, and indices to see all the outstanding bonds, stocks, and indices about all issuers. So if we type, for example, one country, we can see also the indices of this country. So in this case, Argentina, we can see everything. This is quite user-friendly because you just need to type the name of the issuer and you can get all the information. So let's now arrive to the heart, as we can say, of our platform, which is the bond search. The bond search is the way that we provide to our clients to retrieve all of the data that they are looking for regarding the bond market. I would like to remind you that in this moment, we provide information on over 350,000 of bonds in 180 countries. We now provide 100% of coverage of any traded Eurobond, and we provide over 300 primary sources of prices among stock exchanges and OTC market participants. So now I will show you how this bond search works. We are going to make a few examples as a way for you to understand the way it is structured and the way you can take advantage of this tool. And then we can also take some concrete example of bonds and analyze the issue page. So let's try to make together one multi-filter bond search, and then we are going to analyze also some separate bonds. So in this case, we are going to show all outstanding corporate bonds, corporate Euro bonds, with a yield from 4% going up to 8%. As currency, we are going to select USD, and as maturity date, we are going to select all bonds with a maturity going from the 1st of January 2025, sorry, until the 31st of December 2027. So in this case, we are going now also to add the rating of the issues. We are going to select the max ratings from the three major rating agencies, starting from the investment grade, so BBB minus. So now the engine will give us the result of these requests of 284 bonds. So these are all bonds that, as said, I will repeat, these are all corporate outstanding bonds, Euro bonds in USD with a yield from 4 to 8%, maturity from the 1st of January 2025 up to 31st December 2027, and with an issue rating from the three major rating agencies starting from BBB minus. So here you see the results of this demand we made to the database. We can visualize now this result also as a map. So as you can see now, it's very convenient because you can graphically understand where these bonds are placed in a yield duration curve. So this is very interesting. It's a new tool that we provide in the platform. You can also visualize the results by issuer. Also, this is a new tool because you can see the different issuers present in this bond search. By currency, in this case, we don't need to do it because they are all in USD, so we don't need to separate them. So if we go back to the bond search that we made, we can then decide, of course, since the query is quite large, my advice is always to export it to Excel as a way for you to directly use the Excel filters to find the most interesting bonds. Because in this case, for example, we decided that the yield of this query is for bonds between 4 and 8%. So if we decide to go in the indicative yield column, we can decide, sorry, my Excel, of course, is Italian because I am Italian, but I will just filter these bonds. In this case, for example, from the lowest yield to the highest yield, or we can do the opposite. So you can then select in a very easy way the bonds with the highest yield, and then you can find it on the platform. So this, let's say that the Excel export is quite important to save time. Especially when you make very important queries, because in this case the query is big but not so big. Sometimes you can have queries with 1,700 bonds or 2,000 bonds. In this case, of course, analyzing them in the platform, it's not very easy and will take some time. So my advice is always the one of exporting these big queries to Excel and then filtering them further in Excel. So when you make these bond searches, you can save the query. In this case, we can save it as corp USD for 8%, so that the platform remembers about the search that we made. And then we can also decide to select several different queries that we saved before this one. So, for example, during the presentations of our speakers, I saved some queries. For example, this is a query for Chinese corporate euro bonds. So, as you see, in this case, for example, 1,412 bonds. In this case, it would be very interesting to analyze the query directly in Excel. Then also I made a second search, which is all bank subordinated bonds in the emerging markets, because it has been discussed during the presentation. I remember it, so I looked for them, and so I can show you how it looks like. And as always, you can export this to Excel, or you can see it in the bond map, so that you can directly see how it looks like. Let's go back to the query that we first analyzed, so the one that we searched at the beginning. So all the corporate US Euro bonds from 4.8% of yield. And let's select one bond so that we can start to speak about the issue page. So let's select the first bond of this query. So international bond from Adani Ports and Special Economic Zone, 4%, 30 July 2027 in USD. So this is the issue page. So this is the main page for all bonds that we provide, as a way for you to be always aware of what is happening regarding these bonds. So we provide prospectuses about bonds and euro bonds. We have the world highest number of bond prospectuses that you can download in any subscription access that you will have in Cbonds. So let's analyze, first of all, the chart, which is very important. The chart, the price chart, the yield chart, the G-spread chart, and you can go also back 3 years so that you can have an overall look in time about what is happening about this bond, when the bond was suffering. For example, if you want to see during time when the bond started to suffer, in this case, you see how it went down, and of course how the yield went up. So let's say that this in this way you can graphically understand how the bond is changing during time. This is very important, and I would say that our clients are really very, very impressed by this.
Alessandro.
So I was talking about the graph, so you can see also all the different informations about the prices. So we said that we provide 300 primary sources of price from OTC market participants and stock exchanges. This is very important because you can have really an overview of the way the price is changing, and because it's very difficult in the market, you know, to always have let's say the unique bond price. So the most important thing is to have an overview of how the market price is structured. So in this way, you can really see in what way the bond is traded among the market, and you can then therefore have a benchmark that you can then provide to your broker to buy and sell this bond. So this is very important. And we provide a Cbond estimation, which is a mathematical average of the most relevant source of prices that we gather for every bond. So it is quite important to consider the Cbond estimation. Therefore, let's continue. You can see all the information, let's say the technical information about every bond. The minimal settlement amount, the outstanding face value, the nominal of these bonds, and also the cash flow parameters. So all the past and future coupon payments until maturity, and eventual early redemption terms, call, puts. So you can see all the information also about all the options of the issuer. Let's continue listing just the page. We can see all the information regarding also the ratings in here. So you can see all the ratings, the way they change in time about this issuer. And so you can really have an overall look about anything you need to know from a technical point of view about this bond. You will also have an overview of the holders of this bond. This is all about the issue page. Very important all the time that you identify a bond that you think that you would like then or to purchase or you want to follow it. Okay, it's fine. You can add it to the watch list. So in this case, you select one of our sources of prices. I highly recommend to select the Cbond estimation. Then you save this bond. And in this moment, so this bond from Adani Port has been saved in the watch list. We can therefore move to the watch list. And in here, as you can see, we can see these bonds and other ones. So now we pass from the aggressive, let's say, part of the platform where you can find bonds among the over 350,000 bonds we provide. You can arrive to the part where you can defend and monitor the bonds that you own and the one that you would like to monitor for possible potential future purchase, or because you would like to follow their yield, their price, without always looking for them separately. So let's say that now we're going to speak about the monitoring side of the platform. So this is the watch list. You can monitor 200 up to 250 bonds, as you can see in here, and you can see all the most important information about all bonds. Very interesting tool of the watch list is the email notifications, the possibility to receive email alerts regarding the most important events about these issues that you have in your watches. So in this case, for example, these are all the notifications that I have the next 30 days. One very interesting possibility that we provide is the one of receiving notifications when the yield or when the price changes. So for example, if we are following, let's go to the Adani bonds that we opened before. If we want to follow this bond and we want to know now the ask price is 88, so we are going to follow it, and we have in mind the possibility to buy this bond only if he will cost 85, for example. So we can set the price to 85 and receive a notification when the price will be equal or minor 85. So you just write 85, you save it, and in here you can see that the notification has been set, and so you can receive your email if this event will occur. So it's very easy. You can do it for all bonds. You can receive notifications about the most important events of the watch list, so the ratings, coupon payments. These are standards, let's say, for all bonds. Of course, you can see in here, you can see all the notifications regarding price and yield, and this has to be, of course, different for each bond, because you need to personally decide what will be the number inside this box, or inside the yield or price box. So this is the watchlist tool. And now we're going to pass to very quickly to the indices. This is very interesting now, because in the index now we provide the possibility to search in a very quick way. So if we go to the index search, we can decide what we want to look for in a very easy way. I will make an example which is quite relevant, because in this moment it is quite relevant to understand the way a country now is managing. So let's try, for example, to find the credit default swaps of one country, and maybe we can then decide to compare it with another country. So I am Italian, so I will select the 5 years Italian CDS. So here we have it. Can you see it now?
We see the page of index search, Italy, 5Y CDS.
You can see it, right?
Did you press get values?
Yeah. Can you see now the graph or not? Or you
No,
see only?
we cannot see
okay. I need to allow this one, Maria. So So now I think now I can you see it now?
Yes, we can, thank you.
Okay, because I always need to switch on and switch off. I'm sorry for this technical issue, because it's the first time I make an online seminar, so I'm trying to do it, but you know, it happens. So this is the 5 years CDS for Italy. And if we want, we can of course then compare it to another 5 year CDS. So I'm an Italian living in Russia. Let's use therefore Russia 5 years. And as you can see, you can compare two different countries. Then let's arrive to the section of the new section of Cbonds, which is the stock search. So let's say that Cbonds is famous because of its bond coverage, but we decided in the new platform to provide also the possibility to have an overall look about the equity market. So we now gather over 50,000 equities, the most important equities, from 40 stock exchanges. So basically the most famous, let's say, equities. You can now find it in Cbonds. Let's say that equities are easier to find also online, also in free sources, but in any case, while you are working and while you are, let's say, making some bond searches, it's very interesting to have the possibility to find the information about stocks also without looking online, so just looking inside the platform. So we can make a very quick example. For example, we can look for equities outstanding in USA, and we are going to select the healthcare industry. So it works exactly as the multi-filter bond search, but this is the multi-filter equity search. So there is no difference. So same thing, you arrive to this result. You can export to Excel. It is very easy to use, and you can see now that the speed of the platform is extremely efficient. Now you can have the result for every query is of maximum 2 seconds. This is extremely important for people that need to work with a very high speed. So before, let's say that the platform has always been very, very efficient, but the speed was not as efficient as now. Now the speed is really performant. You can use Cbonds very quickly also from your phone, because now it is very adaptive. So as you can see, it is very, very easy to use. Now I will take two equities to show the equity page. This is an NL ordinary equity. So as the bond search, basically, as the bond page, it is very similar. As you can see, there is no big difference. Very easy to use. So all the information about this stock, all the reports, the dividends. Let's make another example. So we can use also the directly in here, the quick search. This is the Gruppo Finanziario Galizia. And you arrive to the stock page, as you can see. So we discussed before about. I would like to show another bond. We discussed about Pemex. Let's take one bond from Pemex. This is the 3 and 5% with maturity date on 30th of January to 2023 in USD. As you can see, what I really would like to focus your attention on is the possibility to compare different prices. This is really important. And this is one of the most important reasons why we have in this moment clients all over the world, because they can have a benchmark, a price benchmark for all the bonds they are interested in. So basically you can find bonds and you can then monitor their prices. So you can really purchase them or sell them at the best market price. So several quotes, as you can see, are of today. So we provide daily quotes for half euro bonds that we provide. We have daily quotes for them. For all German stock exchanges, as you can see, we have daily quotes, and for several also OTC market participants, we have daily quotes. So you really have a benchmark price in this case. As said, we provide the prospectuses basically for all bonds. We have a very wide coverage of prospectuses. And then, as I showed before, we provide all the cash flow of this bond, all the early redemption terms, the identifiers, the placement, all the ratings. Very important regarding the ratings that you can also receive in your watchlist. When you save this bond to the watchlist, you can then decide you can then be aware if the issuer has been downgraded from one or from all the most important rating agencies. So, you will be aware also of the reports of this bond and about the orders of these bonds. So the information is complete to take your investment decisions. So no matters in what region you are focused, we have a full work coverage in this moment. You can find really very important and interesting bonds. We are focused on emerging markets and high yield. So in this moment, the market is full. As our speaker said, even if the situation is quite difficult, the market is full, or for this reason, of interesting possibilities. So with Cbonds, you will be aware of all the market movements. You will be aware of all the possibilities that you can catch now in the market. So I would, if you had any questions, I'm sure that my colleagues of the international department were able to answer to them. You can, of course, write us about any questions that you will have. You can write us to pro@cbonds.info. In any case, we also have the list of all people that decided to join this seminar, so that we can be in touch with you. We are going to have an individual approach with all of you. We have a quite big team because we have a lot of clients, we have a lot of requests, so we have a lot of managers that work in different areas. And we are going basically to adapt also the use of the platform according to the use that you would do of the platform. So we are very flexible. We always try to find the best solution according to your personal requirements. We have very different clients because we go from the retail investor to the most important asset management, to banks, and to important audit companies. So we really have a very important different clients, and we always find the best solution for everyone. So I will now leave you, and I will also I promise also that we will organize some future events. where we are going also to discuss with our speakers about some concrete examples about bonds. So maybe we can also interact with you. We can answer to exactly what you would like to know about certain bonds. It would be very interesting. So especially in emerging markets now, it's fundamental to have an overview about what is happening. So let's try now to organize. I take this responsibility for you. I will send you a newsletter with our fantastic conference team. We are going to organize soon new presentations and seminars. So thank you very much, and see you soon. Bye bye.